Hey everybody, Lance from thetatraders.com here. In this video, I want to go over positive expectancy and looking at probabilities and option trades, why it makes sense to close a lot of trades out early, and why it also makes sense to stop out whenever it goes against us, and just looking at probabilities for large sample sizes. I did write a blog post about it. It's the link in the description down below, and let's talk about it and go over some examples. All right, so harnessing positive expectancy, selling option strangles for consistent profits. These strategies do work in other situations besides a strangle, but makes sense in the math to look at strangles in terms of why we're doing these. Zoom in a little bit. So in the options trading, one of the main ways is to sell options to generate income and manage your risk. That's what we do at thetatraders.com. So in a strangle, you're going to sell a call and a put option at the same time with the same expiration date, but the different strike prices on the asset. So the reason why we do that is you take in credit on both the call side and the put side. At expiration, the price can't go both below the put and above the call side at the same time. So you do get additional premium on these strangles. So looking at positive expectancy, though, this refers to trading systems or strategies' ability to generate an average profit over a large number of trades. An individual trade may or may not work out, but if you do a large sample size, hundreds or thousands of trades, you should have a positive expectancy if you set up your rules in place. So on average, the winning trades, when you multiply the number of wins times how much you make per each winning trade, should be larger than your losing trades, and there'll be a net profit over time. One of the reasons why we sell strangles is for theta decay. So as you get closer and closer to expiration, assuming the stock price or futures price doesn't move, then the options will be worth less because there's less time to get down to the put side or up to the call side. They could have a very high probability of success if you set them up correctly. Typically, want to go relatively lower deltas to have your high probability trades to work out. We do limited risk at thetatraders.com. We stop out at 3x the initial premium. So if you took in $100, we're going to stop out at $300. That'd be a net loss of $200 since we took in $100 to start the trade. And adaptability, you could do these in different underlyings, different DTEs, and do a lot of back testing here to understand the different situations that have the best positive expectancy. So going over the situation for it, let's say we have a 10 delta strangle, takes in $100, and we're going to close at a 50% profit. That'd be a $50 profit. Or you could stop out at a $200 loss. Again, remember, you're stopping out at $300, but you took in 100, so it's a negative $200 play. An example of MES is very common when we use. You sell a strangle taking in 20 premium, times that by the 5 multiplier, you get $100, and then you take profit at half or 10. You would make 10 times 5 or $50, and you can stop out at 3 times the 20 that you took in or 60 that'll stop out. Now, normally there would be about an 80% chance the strangle will expire worthless because you have a 10% chance on the call side, 10% chance on the put side. So you add those two up, you get an 80% chance of success. But by lowering and closing it out early at that 50% profit, essentially the times that by 2, and so you would have, divide by 2, and then instead of the 80% loss, you could have a 90% so for the win rate there. So looking at the positive expectancy here, if you took 100 trades, 90 will win, 10 will lose in the stop out. It's the nature of doing these businesses with selling options. You're going to have some losses, but it's really all about how you mitigate the losses. One way is with a large sample size. So if you took 90 wins, and let's say they took in $50 per win, multiply those out, you get $4,500. If you have 10 losses that are 200 here, not 20, it would be a total of $2,000 at the net loss, 200 times 10. Take the 4,500 you made, subtract the 2,000 you lost, and then you get a net gain of $2,500. And that is a positive expectancy as long as you're mechanically doing these over and over again. You're going to have 9 out of 10 winners. You will have an occasional stop out. What's good about this high probabilities are it's very likely that it's going to work out most times. And it's also very unlikely that you would stop out multiple times in a row. usually have a few winners to offset that loser. So I hope you found this video helpful. If you did, please like, share, subscribe to the channel, do regular update videos and blog posts. If you're interested in seeing all the trades I do, getting one-on-one help from me, and having other like-minded individuals with option selling, then join thetatraders.com. We'll do a free 7-day trial. You can see all the trades that we do, and there's no obligation if it's not for you. Again, Lance at thetatraders.com. Thank you for watching this video, and see you guys on the next one.